Welcome to this lesson on interpreting economic indicators. We're going to break down the three main types of economic signals: leading, coincident, and lagging indicators, and show you how they relate to the business cycle. Now, understanding these time-sensitive signals will help you interpret economic data more clearly and apply it with greater confidence. So remember that economies don't move in perfect synchronization. Some parts of the economy respond quickly. Other parts of the economy take longer to respond to any changes. Different sectors and different data points react at different speeds depending on where we are in the business cycle. Now, this time lag and this difference in response from different sectors is what economic indicators help us to navigate. So what we do is we categorize these indicators into three broad categories. Do look at the accompanying PDF for specific examples within each of these categories. So the three categories are leading indicators, which move before the economy turns. They lead the economy. Coincident indicators, which move alongside the economy, coincident at the same time as. And lagging indicators, they follow behind and they confirm what's already occurred. So each category gives us a slightly different type of signal. So let's start with leading indicators. Leading indicators are our early warnings. They tend to shift before the actual economy does. And they tend to turn upward before a recovery, and they tend to turn downward before a slowdown. So very common examples would be manufacturing PMIs, services PMIs, new orders, building permits. If you think about it, a PMI is simply really a survey that's done of purchase managers. So they'll ask companies things like, are you expecting more orders in the next 12 months? Are you expecting to hire more staff or to fire staff in the next 12 months? So they give you an idea of what business managers' intentions are. So that's why they're able to lead the economy. These indicators are very valuable because they can alert us to upcoming changes before they happen. But they're not foolproof. A purchase manager may feel bad times are coming, but perhaps they aren't. Sometimes fears may grip the market and they can grip those purchase manager indexes and their responses. A very good example would be in 2025 with tariffs, and at one stage people thought the tariffs were going to be as high as 100+% on China. And so of course, imagine if you're filling in a survey when you've just heard that headline, of course you're going to be pessimistic. However, you need to have caution with leading indicators for some of the reasons that I've just outlined. It's very important to remember as well that early doesn't always mean it's accurate. Leading data can be noisy, especially short-term prints. Seasonal patterns or one-off factors, they can cause misleading signals, just like the tariffs that's happened in 2025. So remember, context really matters. So you've always got to think to yourself, it's not just because you see a purchase manager index level drop, that is not automatically a signal that an economy is about to turn, right? So you've got to use these indicators in line with the broader economic trends and the broader macro situation. Let's move on to our next category of indicator, coincident indicators. These reflect what's happening right now. They move in step with the economy. If growth is rising, so are these indicators. If there's a slowdown, they will dip too. So common examples, GDP, retail sales, industrial production. And the best way to think of these coincident indicators, think of these as your real-time snapshot of what the economy is doing right now. Coincident data does play a critical role. It validates as well what leading indicators suggest. If leading indicators are flashing warning signals, but coincident indicators remain strong, we need to be cautious. Perhaps those leading indicators are picking up on fears that aren't actually being expressed in the economy. So coincident indicators helps anchor expectations, helps filter out false signals, and when the two move together, well, confidence in the trend can really increase. If you see the leading indicators are saying a downturn's coming, and then you start to see the coincident indicators confirming that downtrend, then you have more confidence. Next, we have the final category. Now, the final category are lagging indicators. These respond only after broader economic changes have already occurred. For example, unemployment figures, CPI, corporate earnings. They don't predict future movement, but what they do is they confirm and they quantify what's already taken place. Now you might say to yourself, what is the point of tracking lagging indicators if they're telling you what's happened after the event? Well, what they do is they give a sense of the scale. They help us to understand how deep or widespread a shift in the economy really is. And of course, they back up what the leading and coincident data has already hinted at. So all three of these indicators really matter, right? And they matter for slightly different reasons. But leading indicators, they help you forecast what's coming. Coincident indicators confirm what's happening now, and lagging indicators validate and measure the shift, and used together they form a complete picture of the economic landscape, past, present and future. So a real life example would be employment data. So take employment data like non-farm payrolls. It's a bit of a lagging indicator, and the Purchasing Managers Index, PMI, is a leading indicator. So in past recessions, Purchase Managers Indexes, PMIs, have fallen well before the job market started weakening. And that's because the labour market reacts much more slowly. So just remember that key data point is you'll see ISM PMIs falling ahead of official recession. The job losses begin after the recession is already underway. And so you use the PMIs for early warning signals, but the jobs data confirms the severity. So to sum it up, every economic data point fits into a bigger picture. Use the leading indicators to spot what's coming, the coincident indicators to gauge the current conditions, and use lagging indicators to confirm the magnitude of the change. Mastering this framework will give you an edge in navigating markets with insight and clarity. Instead of just seeing a sea of economic data points which come out, by categorizing them into leading, coincident, and lagging indicators, you've a way to not only interpret the economy, but also to see important turning points which can allow you to position yourself on the right side of the market.
Not all data moves at the same speed. Leading indicators hint at what's next, coincident indicators show what's now, lagging confirms what's already happened. Leading gives you early clues. Watch for changes in PMIs, building permits, new orders. These shift before the economy does, but they can be noisy, so use with care. Coincident indicators, retail sales, industrial production and GDP tell you what's happening now. They confirm the trend or show if the economy is holding up. Lagging indicators, unemployment, inflation, they come after the fact, but they can tell you how deep the move really is. Combine all these three to see the full picture.
Once you understand that different economic indicators tell different stories, depending on whether they lead, coincide with, or lag the economy, the logical next question is this: well, which ones really matter? And more importantly, where do I find them all? In the previous lesson, you'll see a PDF explaining which indicators are leading, which ones are coincident, and which ones are lagging. But this lesson, we're going to focus on economic calendars because they're one of the most essential tools in any trader's toolkit. So what is an economic calendar? Well, an economic calendar is simply a schedule that lists when important economic data will be released. Think of it as your event planner for market moving news. There are free versions and there are paid ones. The free tools are useful, but the premium ones used by professionals offer much more context, cleaner visuals, smarter features, and often quicker release times. So most economic calendars, regardless of the platform, follow a fairly universal standard format. The first thing you'll usually see is the date and time, showing when a specific indicator is due. That sounds obvious, but it is crucial for preparing ahead, whether that's later today, this week, or even next month. Each data release is tied to a specific country, or more precisely to that country's currency. Good calendars clearly show which economy the data belongs to, so you immediately know which currency or asset class might react. Calendars also include an impact rating, low, medium, or high. These ratings are based on how much market movement the release has historically triggered, but be cautious. Not all calendars update these labels regularly, and there are times when low impact events can cause big surprises. And there's also times when so-called high impact events can barely move the market. Context plays a key role. But don't worry, we'll explain to you during this course how to find out which economic data points are likely to have an impact. Next, you're going to see columns for the event name, the market forecast, and the actual number when it's released. Some calendars even include color-coded results, not just whether the data beats or misses expectations, but whether that outcome is positive or negative for the economy. Now that's especially useful for data like unemployment, because in unemployment data, a low number is good, right? Because it's less people unemployed. But you might think, oh, that's a low number, it's bad. No, because less people are unemployed, that's a good thing, and that will be positive for the economy. Another thing that can be easy to overlook is how often a data point is released. Is it weekly, monthly, or quarterly? That matters. For example, US PCE inflation has both monthly and quarterly figures, but the monthly version is more timely and influential. Knowing which print carries weight is part of being prepared. The reference period tells you what time the data is actually reflecting. Now, more recent data is usually more actionable. For instance, one of the earliest releases that we have about the US economy is the non-farm payrolls print. And remember, that is released in the following month that it relates to. So for instance, July's release relates to June. So it's quite a quick reference period. Whereas sometimes, if you're looking at a Q1 GDP revision that's come out nearly 4 or 5 months after that time has elapsed, it's not as useful. So you need to see what time is this data point referencing. If there's a release and it's referencing data 5 or 6 months ago, that's not as useful as data that's being released that references data that was taken and collected 2 or 3 weeks ago. Also, don't forget about the revisions. Another often overlooked factor is revisions. Many economic indicators are first released with part of the data, and then it's adjusted later as more information comes in. Now, markets typically react to the newest release most, but revisions can shift the narrative, right? Especially when the original figure was way off. So don't forget, look at the revision to the prior reading. They can be very influential. Some data also comes out in phases, like flash or advanced estimates, followed by final versions. PMI reports, GDP, and even inflation can follow this pattern. The initial release tends to drive markets, but later versions can also bring surprises, especially if expectations shift between releases. High quality calendars, remember, often go a step further by showing forecast ranges. This is important. This is the minimum and maximum projections based on analyst surveys. If the actual number lands outside of that range, it can cause a big reaction. Some calendars even alert you visually when this happens, which is a great edge in fast-moving markets. We will cover this topic in more detail as we go through the course. So to sum it up, economic calendars help you plan for volatility, identify key events, and stay one step ahead. Learning how to use them effectively, not just reading the labels, but understanding the frequency, timing, context, and revisions is a skill that every serious trader should develop. And don't worry if it feels overwhelming at first. The more you work with a calendar, the more intuitive it becomes, and I will show you in this course how to quickly laser and focus in on the data that really matters. It's not as hard as it may seem at first.
An economic calendar shows you when the big news drops. It's your market planner and one of the most useful tools in your toolkit. Calendars break down what's coming, what country it affects, and how much impact it's likely to have. Timing is everything. Some data comes out in waves. It's the flash, revise, the final print. First prints tend to move the most, and revisions can matter more than you think. Make sure you check them out.
Indicators like GDP, CPI, PMIs, and industrial production exist across all major economies. In this section, we're going to highlight a few international indicators that are particularly valuable for traders who want to understand the global macro picture. So let's start with Germany's IFO Business Survey. This is a monthly report, and it acts as a leading indicator of economic growth. It's usually released towards the end of each month. Now, why does it matter? Germany contributes roughly 25% of the Eurozone's total GDP. So anything that signals what's ahead for the German economy has a broader impact for the Eurozone as a whole. The IFO survey matters because it asks over 7,000 businesses about both their current situation and their expectations for the next 6 months. The results are compiled into 3 different indexes. One for current conditions, one for expectations, and a combined one called the Business Climate Index. Historically, this headline leads Eurozone GDP growth by around 1 to 3 months. Now, the Expectations Index is also a strong forward signal for industrial production, both in Germany and the broader Eurozone. A key trick: analysts like to track the spread, that's the difference between expectations and current conditions. When that gap narrows, sentiment is deteriorating. When it widens, businesses are more confident about the future. This spread can be an early read on where economic momentum is heading. Next up is the ZEW Economic Sentiment Index. This is another key German data point. It's released a bit earlier than the IFO, usually around the middle of the month, and it's based on surveys of around 350 financial professionals. Because these are analysts, economists, and traders, it does capture a very market-aware perspective of where they think the economic outlook is heading. And the main strength of the ZEW data is its timeliness. It gives us an early read before the IFO data hits, and the sentiment index tends to lead Eurozone GDP by 6 to 9 months, while the current conditions has a strong coincident relationship with GDP. Together, they do offer early insight into economic shifts in the region. Now, stepping back specifically from Germany, we have the OECD CLI, or Composite Leading Indicators. This series covers all OECD countries plus a few key non-members and is designed to signal economic turning points before they happen. It's published monthly and helps track broader global economic cycles. Now, what's special about the CLI is that it draws on more than 100 forward-looking data series. Each component is chosen based on its reliability, relevance, and how well it tracks cyclical turns in the economy. The goal is to build a composite that serves as an early warning signal for shifts in GDP and business activity. I'll give you a link to the website in the PDF that accompanies this lesson so you can find it for yourself. Now, one practical way to use the CLI effectively is to watch for 3 or more consecutive increases or decreases. That often signals a change in the economic trend for that country. You can also compare CLI trends across countries to identify where growth is accelerating or decelerating. This sets up opportunities for relative value trades between stronger and weaker economies. That is a concept we will return to later on in the course, so don't worry if you haven't got it on the first test. Now, for more advanced use, traders sometimes apply mean reversion models to forecast where the CLI might move over the next 3 to 6 months. Because if you can anticipate a country's growth turning higher before it shows up in the data, you can gain a significant edge in positioning for currencies, equities, or rates that are tied to that economy. So, to wrap up, Germany's IFO and ZEW indicators give us critical insight into the Eurozone economy. The OECD CLI gives us a bird's eye view of global growth trends. Together, these tools complement any US data tracking that you're doing and gives you a much more complete view of where macro conditions are headed across the world. They are very useful international indicators to be aware of.
Global traders need global data. Germany's IFO and ZEW tell us where the Eurozone might be heading. The OECD CLI gives a big picture view of global cycles. The IFO asks thousands of businesses about today and tomorrow. What is the spread between current conditions and expectations? It can signal confidence. The CLI Macro Pulse, the OECD CLI tracks economic turning points across dozens of economies. When the trend shifts for 3+ months, that can be your early signal.